Welcome to Discovery Watch with John Kaiser.
I'm Jim Goddard. John, last week, Novo Resources published an update about its Comet Well project, and the stock dropped sharply, as did that of Tungsten Gold. What did the market not like?
Jim, 2 days before that, we did a pretty lengthy discussion about the Pilbara play, the strength we saw in the Novo stock price, the decision to buy the 4 million shares Artemis held for $5 a share for $20 million by Kirkland Lake. Tungsten Gold had emerged as the sort of unrelated to Novo Canadian-listed junior with substantial holdings in the Pilbara, covering what I call the thin edge of the wedge, where the Mount Rowe transitions to the older basement. And when the news came out, the market was expecting something completely different. The news in itself was not negative. They reported the grades for the two samples from that one pit location where a month earlier they had published the photos of the 80 nuggets or so, ones I had eyeballed at about probably 15 grams per ton for that 7-ton sample, and it came in at 10.4 grams per ton gold. That's pretty good. That's a $400 rock. It's open pit mineable. This should have made the market happy. But then the second sample, which was just beneath that one, it came in at only 1.5 grams per ton, and apparently the market didn't like that low grade because that's not good for very much. However, that sample was half of the basement dolerite rock and half of the conglomerate unit, and you wouldn't expect it to be significantly higher because there is no reason to believe this alluvial-style gold should be in the basement rock. Now, they talked about there being cracks in the rock, and maybe the gold went into it, and so they wanted to assess what happens when you take a piece of the basement rock, and obviously not many good things happen. The market what the market really wants is it wants multiple data points. It wants a dozen such 5 to 7 ton samples from the gold-bearing conglomerate unit. It wants them over a large area. It wants to see, it would love to see consistent grades of 10 grams per ton so that they can connect the dots and say, here we have a 10 million ton block of rock, and it seems to be averaging 10 grams per ton, and let's start trial mining this on a larger scale to firm this up. And then we have a method for looking at all the other strike length of the thin edge of the wedge, this ribbon of conglomerate poking out, and start assessing it there and see if we can end up with a mining scenario of, just mining the edge of this pre-Mount Rowe conglomerate unit. The market didn't like that all we got was a single data point. The reaction is not really justified, except in the context that for the billion-dollar valuation for Novo, yes, it is ahead of itself based on how long it's taking to come up with a protocol for assessing this and being able to do this on a large scale. All this talk about just, let's just go mine this. Well, all that you're ever going to report is the grade of that which you processed, the grade of the sample. And that doesn't work well in discounted cash flow models where you want to project it out for 20 years and say, wow, what happens if we do this for 20 years? You can't do this if you cannot measure the resource in advance. With regard to the negative reaction to Tungsten, it's considerably lower valuation than Novo. As far as I can tell, there's no reason to believe that the area of Purdy's reward in Comet Well is anything particularly special. These gold nuggets are all over the place in the Pilbara, and at some point the market's going to shift away from the flagship story, which is Novo Resources itself, and start paying more attention to the juniors that have considerably lower valuation. But the market's still looking for Novo to show us the protocol, show us the way so that we can emulate you. And if and when Novo does achieve this, then we will have a boom where it becomes something like a real estate development play that whoever has this choice real estate, this thin edge of the wedge. They're going to get the money to use brute force sampling to assess it and demonstrate that, yeah, if we start a strip mining operation here, we will produce plenty of nuggets. And as for the farther down dip exploration, maybe over time there will emerge methods of looking at other indicators, pathfinders within the conglomerate unit, which correlate with the presence of the nuggets. At this point, it's unclear that this will ever happen, which is why Novo ends up being seen as vulnerable to all these setbacks where, we're not getting the information at the pace that we need. So the play is still alive and well, but the market is impatient with the flow of information.
We'll have more with John Kaiser right after the break.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer Gold Mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Welcome back. We're chatting with John Kaiser. John, Peregrine Diamonds recently updated its PEA for the Chidliak Diamond Project on Baffin Island. The stock is up only a few cents. Is the updated PEA a non-event?
The updated PEA was quite an impressive event. They increased the resource that they plan to mine from open pit mining 44% over the 2016 PEA to 16.7 million carats. And that still leaves about 5.5 million carats in the most recent resource estimate that came out in February, still untouched in this resource estimate. And furthermore, the drilling that they did, which established that this pipe extends all the way down to 525 meters, it does not even include an underground mining scenario. So this deposit is even going to be considerably better than it is outlined by this PEA. Now, they did make the formal statement that a recommendation has been made to go to pre-feasibility study. And pre-feasibility study drops the error margin, error accuracy level from 30-35% in the PEA down to sort of 20-25%, and will probably cost another $30 to $50 million to reach this target. The capex and the operating costs were not negatively affected, as you often see when you do an update. One of the things the market that did not like is that they continued to use a diamond price inflator. They used a 2.5% inflator in the 2016 PEA. They used a 1.75% inflator in this one. They did, however, provide a table where they showed what happens when you use a 0% inflator. And an inflator is where you increase the annual price of the commodity you're producing, in this case diamond, by a certain percentage that compounds over time. It's generally frowned upon. Discounted cash flow models are not supposed to use a so-called inflation adjustment for both the costs and the revenues, because it artificially expands the total profit, which is helpful for doing a net present value calculation in a way that doesn't reflect any reality. But to use an inflator on the revenue side, you need to have a good reason to expect the price of the commodity to increase over time above and beyond general inflation. Now, the story in the diamond sector has been, because of depleting natural diamond supply over the next 20 years and a growing global economy and the increasing demand, there will be a trend to higher prices for natural diamonds. This, of course, has not been the case in the last couple of years when we have had a bear market in diamonds. In fact, the price of diamonds increased only 1% from 2016 to recently in April 2018, which sort of puts in question, well, why are you justified in using a 2.5% inflator? However, diamond prices now are the highest they've been in a year. They seem to be strengthening. De Beers just made it official that it is now going to produce synthetic diamonds. And one of the big concerns in the last while has been the emergence of synthetic gem diamonds as possibly destroying the market for natural diamonds, because theoretically, as you lower the cost of the technology to produce synthetic diamonds, you can just keep undercutting the natural diamonds and eventually destroy the market for natural diamonds, whose scarcity and whose real extraction costs you really can't do anything about. But by De Beers officially going in and branding these synthetic diamonds as costume jewelry that everybody wants, they are causing a bifurcation in the way the consumer perceives diamonds. The natural diamonds are seen as collectibles. There's all this talk, too, about using blockchain technology to enter diamonds that are from a natural diamond mine into a distributed database so that your particular collectible that you purchase has a chain of custody from its source, all documented, and when you go to resell, you can demonstrate that this is not a synthetic diamond, this is a natural diamond. So there is a burst of optimism which may allow one to start considering an inflator. It's still not a good idea to do that. I think this project stands on its own. Even when you when you use a 0% inflator, the project's NPV is high enough. It exceeds the capex, and that's a major hurdle. And the internal rate of return is also significant. So, given the expansion potential of this project in CH6 itself, plus CH7, this project definitely deserves to go ahead with the pre-feasibility study. And then the question is, why is the market reaction so lame? Well, the reason is the market remains suspicious about what the agenda is of Robert and Eric Friedland about moving this company forward. There isn't enough money left to do any work. By the end of September, they will have no money left at the current burn rate. They spent $600,000 on exploration in the first quarter, and you kind of wonder, well, what exploration did they actually do? The rest goes to sustain the overhead of the company. Their budget for investor relations in the first quarter was $18,000, so clearly they're not spending any money to encourage a broader audience to appreciate the value of this play. So this is the most undervalued diamond junior out there based on what has been disclosed with this level of work done. Over $60 million put into this project, an NPV over $500 million, reaching into $700 million Canadian when you include the inflator scenario. So it's a puzzle that this project is this cheap, and it remains kind of a wet blanket on the whole diamond sector, because if this is the market valuation that a project which has accomplished so much achieves in the market, then what is the point of exploring for diamonds at all?
We'll have more with John Kaiser right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're chatting with John Kaiser. John, in late 2016, you introduced Playfair Mining and its Ox Mountain project in Ireland as a Discovery Watch Junior. Whatever happened to that story?
Well, in late 2016, Don Moore, who's been around in the Canadian junior scene for decades, he created quite a stir, got people excited about this new target he had generated through a group of geologists in Ireland. The goal was to find something like Dalradian's Corraganaut deposit in Northern Ireland. That's about 4.3 million ounces of 10 to 12 gram per ton gold, an underground mining scenario, structurally controlled system. At Clunacool, they thought they had something similar. There was a 4.5 kilometer conductor within what appeared to be a structural corridor. There was a gold float found in the fields, a high-grade gold float tracking about a 1.5 kilometer stretch of this, and they tackled this with a 9-hole shallow drill program. But all it got was these intervals of generally less than a meter and less than 4 grams per ton gold. It didn't explain the gold float. The grade clearly isn't high enough to be interesting. And it just took the wind out of Don Moore's sails, and he pretty much was in hibernation all of last year, waiting for market sentiment to turn around. Now, they have managed to raise another $500,000. They want to return with a 3,000-meter drill program, which moves west along that structure and tackles more than just about a 100-meter segment of this 200-meter wide corridor. This time they're going to have to make or break it. The market won't give them a better chance. But today the situation is better for anybody who's interested in a high-risk, high-reward discovery exploration play. A year and a half ago, the outcome of the Ox Mountain drilling, you were at the mercy of that. If it wasn't good, the stock was going to go down. This time around, the company has a backup plan. Now, it has had this backup plan for quite a few years. It is the Grey River Tungsten vein deposit in Newfoundland, for which it completed a PEA in 2011. That was when tungsten APT was almost $450 per MTU. They did their base case price at $355 MTU. That wasn't particularly profitable at that. It's a small capex mine, 400 tons per day, $32 million capex. But then afterwards, tungsten plunged back into the $150 to $200 per MTU, where pretty much every Western tungsten deposit is not worth mining. Over 80% of tungsten is produced in China. And since the middle of 2017, tungsten has emerged from its doghouse and is now around $345 per MTU. And this is before Trump's trade war really gets any traction. Right now, so far, it's just been saber-rattling and threats and so on. But if this starts to escalate and we have this return to America, let's reshore everything, force everybody back to America, there's going to be a problem with tungsten. And tungsten isn't just a very important metal for the construction industry, for the fabrication industry, because it is a key part of tools. It's also known as the war metal. And as the United States starts to ratchet up its sort of war footing vis-a-vis countries that annoy it, one of them possibly being China, if this summit with North Korea doesn't really pan out in anything useful, or worse, results in some sort of military conflict over there. Tungsten is the most important metal where the United States has a major security of supply vulnerability. Now, the Grey River project of Playfair, it's not a large project. But it would benefit from rapid development. A much more important project is the Sisson project of Northcliffe Resources in New Brunswick. It's been plodding along in the permitting cycle, which has been just as well because the price of moly and tungsten has been too low to put this project into production. They conceivably could supply 8% of total global production if they were into production. But the Grey River high-grade tungsten could potentially end up being blended with an operation such as that if it got off the ground. And there's possibly more exploration potential in that area. So if this next round of drilling at Ox Mountain fails to deliver the goods, fails to confirm that there is a pot of gold here at the end of the Clonakul Rainbow, the stock is not going to go to half cent and be there for a 10 for 1 or more rollback. There is the Grey River project, which is heading back into the money and could become the focus, get the spotlight for the company. And of course, in the best scenario is one where Ox Mountain does deliver the goods, turns Playfair into a discovery play in its own right, and then they can spin out the Grey River project as a separate asset to be acquired or funded further work by the group that's interested in the possibility that tungsten can end up a lot higher than it did in the last cycle.
John, thanks a lot for the update.
You're welcome, Jim.
I've been speaking with John Kaiser, his website, kaiserresearch.com. I'm Jim Goddard.
Comments made on Discovery Watch are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Discovery Watch is a production of How Street Media Incorporated.